we are back here on the first trade, and we've got stock futures lower across the board. Let's check in with Jared Blickery. Jared, it looks like the S&P 500's 4-day winning streak may be in jeopardy here.
Yeah, a little bit of a pullback here, especially after the jobs data and some of the other data that came out at 8:30. We do have stocks under a little bit of pressure here. Just looking at the Wi-Fi interactive world map, we can see that we had some strength in Asia just a little bit early on, but broad weakness in Europe. In London, the FTSE is down about 0.8%. The DAX and CAC 40 also down, but under 1%. In the the S&P 500 futures, as you noted, under a little bit of pressure here. And here's what happened after the jobs report.
I hate when people call me like right as I'm streaming. Like,
there we go.
You see the notification, and then you call me. Like I ain't streaming. All right, chat. What's up, y'all?
We came off
I'm back.
Level here, 31.30.
Stock market opens in 3 minutes.
We haven't seen that.
I didn't really pay too much attention to the pre-market,
and it's kind of the last.
I just know I saw a lot of green.
So not necessarily that we have to go down from here materially, but probably taking a little bit of a pause. Let's take a look at some of our other markets, because we do have some interesting things going on in bonds and also the U.S. dollar. Now, bonds are staging, at least the yield is staging a comeback here. If I can get a chart of the 30-day. No, it looks like my charts are all out of whack here. Anyway, we do have bond yields climb to their highest level that we've seen in several months.
Market opens in 2 minutes and 11 seconds, man. Things are looking real good today, man.
All right, even though we can't see the chart, I believe you, Jared. And crude oil is pulling back a little bit today, down nearly 1%. We're going to talk more about in a little bit. Stay with us. So the opening bell coming up on the first trade.
Some of the stocks are pulling back, but most of my trades are winning trades, so I'm fine. Once the market opens up, I'm going to take a look at some earnings reports, see what's going on. $35 seconds, baby. Opening bell. All right, here it is. Let's see what we got here. Damn, profit today.
And we have another day of trading underway on this Thursday morning. We saw stock futures coming under some pressure here for the first time in about 4 days. Looks like the Dow Industrials are going to start the day.
I got into American Airlines right before they closed, and I had a watch sale penalty with it. And I'm still up 6%. That's nice to know.
And Brian Sazi. Good morning to you all.
Delta Airlines, I got in that right before the market closed yesterday.
The market, what has been driving this market lately? Because it doesn't look like it's been
Fitbit,
the pandemic or the civil unrest we've been seeing in this country. So what's sort of been driving the momentum?
Well, first of all, Lex, if you think about it, since March 23rd, the markets have kind of pivoted, and we've seen markets are up. The S&P 500 is up almost 40%. And I think a lot of people are seeing a disconnect between what the markets are doing, what the real economy is doing. But I actually think what you're seeing is the markets are actually reacting rationally what they're responding to is this extraordinary policy deployment. So think about this: between what the Fed has done and what we've seen elected officials do through fiscal policy, this is the largest mobilization of government resources, certainly since the Second World War, and arguably ever in peacetime. So that combination of just extraordinarily accommodative monetary policy and increasingly muscular fiscal policy is allowing people to sort of look past this sort of void we're seeing right now in terms of the pandemic-related downfall in the economy and that bridging process that we see into 2021. So I think we're looking through this year in terms of both the economy and earnings and into normalization in 20 and 21.
Mike, it's not just the U.S. With fiscal stimulus.
Damn, man, everything is just so
what the ECB
clean.
Did this morning. That is just extraordinary policy. And do you think that we were asking a lot this week, is the market overvalued? But in light of this stimulus, do you think the market is undervalued? And we could appreciate 10 to 15% into year end, even despite all those things we're seeing in the country and even with COVID?
Look, there's certainly prospects that we could see a further melt up in markets.
I'm about to look at some earnings plays in a few minutes.
That markets are now undervalued relative to what we've seen in terms of both the policy measures and where markets are repriced. I think the markets have accurately reflected the extraordinary policy reflex response we've seen, again, both by central banks and federal government. I think what's going to be required now for markets to continue to grind higher is we are going to have to see some progress on three fronts. One, we are going to have to see that the war against pandemic is yielding some meaningful and sustainable results. In other words,
all right, let's see what we can come up with today.
Base loads continue to decline, so that's one thing we're going to need to see.
Second,
we need to see that there was enough of the commercial infrastructure that was preserved through this dark period.
Camel Soup still looks good. I don't care what nobody says.
One of the
Camel
concerns
Soup
we always had was that when you have
it
these
looks
kind of
good.
shocks, unless you have a massive
One,
policy response,
it's used for the coronavirus. Two,
is a concern then that
flu season's coming up.
Destroy a lot of the commercial infrastructure.
That's why I like it. I'm gonna hold this one for a while. I'm glad I bought some shares in this one.
Thought that was my dog for a second.
So the issue here is that we need to see the economy is going to work through that transitional period. And maybe the last thing is I think we're looking also for some pharmacological progress.
All right, so let's take a look at some earnings reports.
I'll tell you, that little dog doesn't agree with you very much, Lexus.
It's okay. We've had babies crying and dogs barking, so that is a symptom of working from home. Where are you putting client money to work right now? I mean, is it primarily in U.S. equities, and if so, what sectors?
Well, first of all, we are actually taking an approach where we have.
Oh, this one got a real good market cap. Let's see.
The equity market's probably gone ahead of the credit markets, and that we do see some opportunities in credit, both investment grade and high yield. In terms of our sector positioning, we've actually increased our cyclical exposure because while the market has run higher, there have been some laggards, and we think there's going to be some catch up now.
Mm-hmm.
So
yeah, I
we
see
do
it.
have a moderately cyclical bias. The three sectors we're focused on right now is going to be.
That's a good one for me. I think it's good. Brokers is a good one.
Also industrials. We just recently upgraded our industrial exposure. So again, it's a little bit of a mix between defensive and cyclical, but we're coming increasingly cyclical, and we also have a preference for mid-cap stocks in this environment.
All right, Jared, I want to get over to you. Before the opening bell, we talked about how the 4-day winning streak for the market was in jeopardy. What do you see moving us early here in the morning?
Well, we have discretionary. Consumer discretionary is the only sector of the 11 in the S&P.
JM Smuckers, ain't that the peanut butter?
Outperforming is staples, also in materials and
SJM. Let me take a look. 100 and something bucks. Damn, that's a big move right there. Let me go ahead and close this chart out.
Real estate, energy. We have crude oil down about 1.5%, despite OPEC.
Kirkland,
the Saudis and the Russians agreeing to extend the production cuts for one more month. But just looking at the
I don't like
NASDAQ
these
heat map, we can see FANG stocks and big cap stocks under a bit of pressure, except for Amazon. That's carrying the discretionary sector. Sorting by performance, we're going to see some travel stocks up there. The airlines are really catching a bid this morning. China is going to be reopening U.S. flights with China, not only for their own carriers, which they've already done, but ours as well. And also the federal government is easing some of the restrictions on the travel on the airlines in terms of the points that they have to serve. So in other words, they're going to be able to cut some costs. But it looks like the chip stocks kind of underperforming. Broadcom here, we see it down 2%. That is
Broadcom
in the Dow.
It's not bad.
The NASDAQ 100. They reported earnings after the bell yesterday. Microchip down as well. Even Zoom Technologies it's down today, still up 6% over the last 5 days, and year to date still up 223%. But just looking at the sector action, once more, we can see industrials, discretionary materials are in the green right now. And I just wanted to point out something kind of bigger picture. We have this interesting stat that comes from LPL Financial. We are on the best 50-day rally ever. All right. And so what does that mean going forward? Do we get a sell-off? Actually not. Going 3 months, 6 months, and 12 months, the outlook looks pretty good. The median return over 3 months is 6%, 6 months is 9%, 12 months is 19%. But as I said earlier, kind of taking a pause here after we hit that resistance level on the S&P 500, Alexis.
Mike, you just heard what Jared was saying. The market, no surprise to you, I'm sure, is in major rally mode here. Do you think what we're seeing on the street is fear of missing out?
I think that's a bit of it, Brian. Remember, we're seeing this massive rally, but it comes off to an extraordinary sell-off. You think up until March 23rd, this was the most significant and sustained accelerated sell-off we've seen in history as well. So it's not terribly surprising that we're going to get a fairly sizable bounce back from here. So I do think what you are seeing now is that there are some people who have been caught off sides here. People who are looking for perhaps that we'd see a secondary outbreak or that the impact of the pandemic on the global economy would be sustained for a longer period of time. So I think there's been some unwinding of that initially. I think what you are starting to see now is people who thought that the recovery would play out in a much more methodical fashion, people who were sort of waiting for entry points are now being forced in. So you're starting to see increasingly now that people are looking at, looking through again this transitory period and focused on what we'll see in 2021 and 2022. So to me, I think there is a little bit of this anxiousness right now of people who missed the first part of this route on the sidelines forever.
Mike, tomorrow we get the May unemployment report. It's going to be a market moving report, and we're expecting another horrific number. But is the market basically discounting this now because economies are starting to reopen? It is such a backward-looking number.
Yeah, Alexis, I think employment reports are always important. If you go back, I would argue it's probably one of the most important economic releases we get each month because it's relatively comprehensive and it gives you a snapshot of things that are happening in terms of demand for labor and also in terms of what's driving the economy and also cost. So it is a pretty comprehensive measure, and it's one that's also tends to be relatively timely. I think we have to take most of the high-frequency economic data we're seeing right now with a bit of grain of salt, because the facts on the ground are changing so quickly. And as you just mentioned, it is backward-looking, and what we're seeing right now is the pandemic slowly unwinds, and as we start to see the reopening, the dynamics in terms of the economy are changing so quickly that you can't capture that with monthly employment data.
If Mike, do you think if the headline number comes in better than expected, the market does rally? And I ask that because we've seen a stretch over the past week and a half where economic data has come in much more, I think, much better than a lot of people expected, and that has been the fuel to this rally.
Yeah, I think you're right, Brian. First of all, look at what we're seeing in terms of the ADP numbers, the ISM numbers, and certainly even the personal income numbers. When we saw above consensus reads there, we saw it as a response. Again, there had been this expectation that this recovery process was going to be a long, drawn-out affair, that it would happen in incremental doses. And what you are seeing is the quicker there's a bounce back, people are starting to talk less and less about L and even more or less about U, and perhaps even that this may be a really, really deep V recovery where things bounce back much more quickly. And I'll go back to one of the things I said before, Brian. Part of what allows for this recovery was preserving the commercial infrastructure. And I can't emphasize that enough. One of the worst things that could happen is if policymakers had done nothing. And what we would have seen then is we would have seen bankruptcies, defaults, we would have seen liquidation of assets, we would have seen business failures. And then to restart the economy is incredibly difficult because you have to go through the process of new business formation, raising capital, establishing credit lines, entering into contracts, hiring workers. That takes an awful long time. So the more of the infrastructure we're able to preserve, the more of an economy there is to bounce back as we reopen. I'd also argue one other thing that's probably constructive here, which I think people didn't appreciate early on, was the fact that this economy has a staggered story, that we're not trying to reset everything at the same time. What we are seeing is regions that were less affected are starting earlier. And that's important because we're getting critical information about what works and what doesn't work. And that information can be applied across the rest of the economy. So that real-time processing information means we're finding out that there are certain types of businesses and services we can open earlier than we would have thought because the infection rate is not spiking in those instances.
All right, Mike Ryan, America's CIO at UBS Wealth Management. Pleasure. Thanks for being with us.
Thanks, Alexis.
And stay with us. We're going to take a deep dive into the oil pits with John Caruso on the other side of this break. All right, let's talk a little oil here. We've got crude oil down more than 1.5%, 36.66 a barrel. It looks like Saudi Arabia and Russia have agreed to keep deep production cuts in place into July, but the rest of OPEC Plus is not yet on board. And that just as hopes are growing that reopening economies could push a big increase in demand for oil. Let's talk about this now with John Caruso. He is a senior asset manager at RJO Futures in Chicago. John, good to see you again. So is extending these cuts enough to boost the price of oil?
Well, I think you've got to kind of take a look back and look where we were and in terms of how far we've come. The price since the July contract low, we've rallied more than 100% right now. So I'm actually in the camp that believes that we could see a 3 to 5% correction, a little bit of a setback from here. We are seeing some softness in the market this morning, perhaps a little bit of a buy the rumor, sell the fact type setup in the market. I think the one thing you want to really keep an eye on is compliance going forward. We do know that there's the Saudis and Russia's, there's a handshake agreement to extend the cuts through July. But from what I've seen, compliance of the 9.7 million barrel cuts per day back in May was only running at about 74 or 75%. So there was some cheating going on in the market. I really think you need to watch that going forward, and you're going to see that in the weekly inventory numbers.
John, you know me, you've been on enough. I'm always looking out for oil price spikes somewhere, but I think I finally have a case to be made that maybe we do see an oil price spike this summer, early fall. Look at the market, look what the stock market's doing. FOMO, rip-roaring rally. Why hasn't oil caught up yet?
Why hasn't it? I'm sorry.
Why has it not caught up yet with the market rally? Just the broad market rally in stocks. Clearly, the market is saying something.
Sure, absolutely. Well, I'll tell you what. I mean, this reopening of the economy, it's happening very slowly. I can tell you just from being here in Chicago that there's still a lot of downtown that is still very quiet right now. A lot of offices haven't reopened. So you're not getting that commute to the bigger cities every single day. So the demand side of the equation is still very much, there's a lot of question marks hanging around demand going forward. We have certainly seen a big step forward in terms of the supply demand fundamentals with the production cuts. Slowly, the economy seems to be coming back online. But if you look back at yesterday's inventory numbers, we did see some softness in the products. We saw some bigger builds than expected in the products. And that certainly is a factor with demand.
John, looking back at how we emerged from the Great Recession, does that tell you anything what might happen with oil as economies start to open up?
To be quite honest with you, I mean, going forward, after perhaps a 3 to 5% correction here in the near term, going forward, we actually are going to be pivoting to being very bullish on oil. I do think you could see oil run up into the mid 40s at some point over the summer. There is a gap in the market up at 42 that I do think the market's going to likely close at some point from July to August. So, after perhaps a small correction here in the market, we're going to be looking at becoming more bullish on the price of crude going forward.
But John, do you think that fundamentally the pandemic has sort of shifted oil markets going forward?
Sure. There's no question about it. Until we start to see lower viral loads, we actually have seen lower viral loads, but everybody's kind of awaiting, are we going to see that second wave hit us in the fall time again? So there's still a lot of question marks in terms of where demand is going to be a year from now. But I do think over the course of the next couple of months, it's not going to shock me to see the price of crude oil reflate into the $40 level.
And John, longer term, I think the pandemic has showed us that we can get our work done at home. We can get it done at home. What's the longer run outlook for oil, do you think? Maybe we're taking less public transportation. Maybe we're driving to the work less. Certainly, maybe we're taking Uber and Lyft less.
Sure, absolutely. The game has completely changed going forward. We're going to be monitoring those developments going forward. I do know that in the back half of this year, OPEC is likely going to be tapering these production cuts. I believe after July, they're expected to fall back to 7.7 million barrels per day through the end of the year, and then lower it even beyond those levels out into next year. So, there's a lot of question marks in terms of demand. Like you had mentioned, the game has certainly changed in terms of transportation. And there's a lot to certainly be looking forward to in from that regards.
All right, John Caruso, Senior Asset Manager at RJO Futures there in Chicago for us. Good to see you again.
Thank you so much.
All right, stay with us. When we come back, we're going to take a look at how office buildings are re-strategizing amid the pandemic, and we're going to hear from Ariana Huffington on that and many more right after this. There are now over 1.85 million confirmed cases of COVID-19 in the U.S. That's according to Johns Hopkins. And that is changing the way we think about the conventional office space. Akiko Fujita joins us now for more. Akiko, as part of your series, you spoke with some big names in the commercial real estate space about how they're changing everyday business. What did you find?
Yeah, Alexis, it's interesting. We've talked so much about the tech companies like Facebook and Twitter making this more permanent shift to work from home. But the reality is most companies are looking at a more fragmented workspace. So we're talking about some visits to the office with staggered hours, some work from home, and yes, still a lot more Zoom calls to come.
So the first thing when they step out of the lift is they're going to notice that the doors are open. So they're not going to have to touch a door to come in.
Americans returning to work face a dramatically new office experience.
You've got 3 chairs here. How many did you have before?
We would have had 6 before.
There's less furniture here and fewer desks.
What we do down these line of workstations is we take out every other workstation and then people will be able to maintain that safe distance.
And there's plenty of reminders to keep that distance, as we learned firsthand. Cushman & Wakefield calls this the 6 feet office.
2 of the areas we're really focused on is maintaining that social distance while we're in the office, also just reducing the number of touch points.
Employees here use keys instead of their fingers. They stand in marked corners. They're required to walk clockwise around the office to avoid congestion.
The overarching approach has been, how do we create these safe environments with a limited amount of time and a limited amount of capital to make them accessible for everybody?
Other offices are turning to tech, installing thermal imaging cameras to check temperatures and air filtration systems. WeWork expects employees to stay closer to home now. It's launching software to help clients find locations nearby.
This technology that we're putting that we put together and we're rolling it out gives enterprise companies the ability to map out their people to our various locations. If you have 4,000 people, they don't all have to be in 1 or 2 locations.
What does that mean from a business standpoint from WeWork? On the one hand, you're saying there's an opportunity of more businesses coming in, but just as equally, you've got to have a lot of businesses that may not have the same footprint they did pre-COVID.
Net, we have greater demand today than the members that we've lost. Enterprise is about 46% of our business today. We expect that number to grow to about 70 to 75% of our revenue over the next 12 months.
But companies like Facebook and Twitter see remote work as more permanent. That's altering the definition of the office.
Do you think we're seeing a permanent shift in the way we actually look at the workplace?
I absolutely think we're never going back to exactly where we were. And in many ways, that's a good thing. I think there's going to be much more of a hybrid future of working from offices and working remote.
Huffington expects that to lead to a shakeup of C-suite roles. Mental health now a priority, with employees working in isolation.
Who takes on that role of ensuring that part of the equation?
The heads of HR departments are now the most important executive in the company other than the CEO. The health and wellness of employees has now been moved to the front burner.
The changes giving new meaning to business as usual, with our workplace changed forever.
Now, Cushman & Wakefield did a recent survey looking at all of their properties globally, but also speaking to their tenants. And they found that 50% of those in the workplace plan to use this, what they call this total workplace ecosystem. So the fragmentation of a little work from home, a little work from the office, more online. What I thought was interesting about all this, in my conversation with WeWork, they said, look, we're going to have to start thinking about headquarters no longer being a thing. So those big office spaces we're seeing here in Midtown Manhattan, more and more people are not going to want to take the train into work. And so now you're seeing these companies also looking at the suburbs to see if they can lease out some office space there.
Yeah, it sort of really puts WeWork though up on its head, doesn't it? I mean, their whole strategy just sort of gets upended with not a lot of people needing to be in one place at one time. But I'm curious about cost. Who's going to be burdened with that? Is it the landlord? Is it the company themselves? Is it a shared cost to outfit the space the right way?
Yeah, it's a shared cost, but that's why you heard Cushman and Wakefield there say, we're trying to come up with solutions where people feel comfortable, where people are safe, but that don't have a very high capital cost. Because when you think about it, yes, there is still that potential for a second wave, but how long is this really going to last until we get that vaccine? And so what you're seeing a lot of companies say is that they don't want to make these huge investments because ultimately they think that there's a possibility this may all go back to where we used to be once the vaccine's in place.
Well, we are holding out hope for that. Akiko, thanks so much for that reporting. Fascinating stuff. All right, let's check in with Jared Blickery for one more check of the markets here in this 9 o'clock hour. Jared?
Yeah, we got a mixed market underway. Dow is down just slightly here, about 10 points, trying to fill the gap. The NASDAQ up 16 basis points. Biotech is outperforming, and chip stocks have come from being the early laggards to early leaders. S&P 500 down just nominally about 2 points there. Here's the two-day price action. You can see we just kind of dipped into yesterday's midday range, and now we're trying to fill that gap right there. Over the last 15 days, we are up 10.7%. And year to date, this gives us a picture of the resistance level at 3130 that we just hit yesterday, which may indicate we may be due for a slight pullback here. Also, I want to get to the bond market because it is staging a breakout, at least in terms of yields. And we can see this on a 3-month basis. This nice rounded bottom that we have here, we still want to see it close above 80 basis points. That's this level right here, but some constructive motion for risk markets right now. Finally, US dollar index. That is up right now, breaking a 5-day losing streak. Might have to watch out for a false breakdown here because the US dollar is famous for that. And just look at the NASDAQ heat map here. It is kind of a mixed market, but the FANG stocks are in the green, Alexis.
All right, thanks very much for that, Jared. Also want to tell you today that the trade deficit widened. U.S. exports and imports both posted their largest monthly decreases, on record amid the coronavirus-related shutdowns around the world. Coming up on the first trade, can the electric truck company Nikola become the next Tesla after going public? We're going to speak with Nikola's CEO coming up after this.
All right, welcome back to the first trade. I am, of course, joined by my co-anchor, Alexis Christoforous, and you're seeing the market come back off the worst of today's session. You're seeing the ECB come out, major new bond buying program, and no doubt about it, FOMO, or fear of missing out, has gripped Wall Street. But before we dive into the markets here, let's get right to Inez Ferre for a look at some stocks here. Inez, you're on the retail beat right now.
I am, Brian, and I want to show you what's happening with eBay hitting a record high of more than 6% after the company raised its guidance for the current quarter. eBay saying that business is performing significantly better than expectations that it shared in the last earnings release. It increased its range for its earnings per share. Taking a look at Michael's, that stock is down more than 7% after a disappointing first quarter. Same-store sales were down more than 27%. The company reported a net loss compared to a net income a year ago. Michael's introduced curbside pickup and same-day delivery. Its e-commerce grew by 296% during the quarter. It does expect all of its stores to open by the end of the month, but year to date, the stock is down 47%. And then just taking a look at Twitter slightly under pressure, but also I wanted to show you, besides Twitter, also Boeing. That's the next stock I was going to. Boeing, up more than 4%. Best performer right now on the Dow today. Amazon said at least 12 Boeing 767 jets converted to cargo from its air transport services group to meet the surging demand for online orders. And one of the new aircrafts joined Amazon's air cargo operations back in May, with the remaining 11 joining in 2021. And Amazon has really broken out from that 150 level that it was hanging out at for a while. You can see over the last 15 days, that stock really rallied. Brian?
Yeah, I guess folks aren't knitting and buying fake flowers at Michael's. Tough quarter for them. We'll talk about it.
Back to soon.
Let's stay on the markets here and bring in Megan Horniman. She is Director of Portfolio Strategy at Verdance Capital Advisors. Megan, good to see you again. And as I mentioned at the top of the show, the markets are coming off the worst of the session. As you take a step back and you study these markets, you look at valuations, do you think the market is simply getting frothy?
I think in the near term, you definitely could see a period of consolidation. If you look at some of the technicals in the market, whether it's the low put to call ratio, which tends to signal some complacency entering the market, or it's some of those momentum indicators that are signaling overbought conditions, we have had such a significant run off of the bottom. Some of these US indices, for example, are up 40, 50, 60% from the lows, and the NASDAQ has actually entered positive territory for the year. Now, what history does show us is that when you have such a steep decline like we saw in March, you do tend to see a pretty big momentum rally after that. However, you do tend to see, once you get into these types of levels, that there is room for some near-term consolidation as people look at valuations that are at heightened levels.
Megan, where might we see that momentum coming from in terms of sectors? Are you going to start to see a rotation out of the cyclicals and maybe into, I don't know, defensive plays, maybe elsewhere outside of U.S. equities, perhaps?
So you have seen some of that momentum or that style shift in recent weeks. Actually, you've seen some of those sectors that didn't participate in the beginning of this rally start to participate in this. So there is some positive signs that we are seeing the breadth of the market a bit better. We think that rotation can continue because people will be looking for value where people have left that behind. So we think that'll continue not only within the U.S., for example, in the small and mid-cap space, the value space, but also internationally as well.
Megan, I've got market melt-ups on my brain this week. I'm looking for them. I'm seeking them out. And, I look at what Zoom did yesterday, came out, beat big. The stock pretty much went up in a straight line. To me, that's somewhat of a market melt-up. Where are you seeing pockets of overvaluation? Is it stay-at-home stocks? Is it those 5 big cap tech stocks that have essentially powered the market off to the lows?
Yeah, I think it's definitely those big cap stocks that came off of the lows so strong and made up the majority of the start of this rally. That's called a momentum play, and it's dangerous to follow that because that can quickly shift when sentiment shifts. So we're waiting for a better entry point into some of those areas before we would feel comfortable adding there. But you have to remember as well, this melt up is being driven by a couple things, and really 2 in particular. The first one is that the Federal Reserve is pushing investors into the equity market. When you have about 90% of the stocks, in the Russell 1000 paying a dividend higher than the 10-year bond yield, the Federal Reserve's doing what they were set out to do, and that's to push people into risk assets. The other factor is that when we came into this pandemic, the one thing was really unknown was the human element and the emotion on how they would return to the economy. So while a lot of the economic data is backward looking, we can look at things like air travel, turnstiles in New York City, public transportation. We can look at the amount of people, their weekly gas demand, and we can see that appetite that consumers are as far as going back out and re-entering the economy. And that's a positive, and that's what the equity markets are holding on to right now. Now, once we start getting the real hard data in June and July, that may test the sentiment as well.
Megan, how important is tomorrow's May jobs report to this market? Again, because it is backward looking, how much of it are you really, looking at in terms of trying to guide the way you're going to be looking at your portfolio?
So right now, the backward-looking data, while it's important, we're more focused on the forward-looking data. So things like today with the continuing claims, that was discouraging because you did see that tick up. While the number of jobless claims came down, you did see that continuing claims tick up. So that's a bit more important. Some of the other underlying forward-looking labor market indicators that we'll look at is in some of the business surveys. So while an unemployment report is always important to look at, we're really going to be focusing on some of these other forward-looking economic or labor market indicators to see what the impact on the economy is.
Megan, given the stimulus we have seen that has been pumped into this market, do you think we break through the February highs before year end? Or maybe even earlier? Look, the S&P 500, 7.6% away from those February highs now.
It's certainly possible. I mean, I think when we were looking at the depths of the lows in March, that if anybody had to foresee that we'd see a 50, 60% rally as quickly as we have out of those lows, I think some people would be surprised at that. So I think it's definitely possible, but there's going to come a time where the underlying fundamentals need to support these valuations. And that's what really is going to be tested in the coming months, because as I mentioned, we'll start to get some of the hard data from when these states started to reopen.
What about some possible headwinds in addition to, we know, the ongoing pandemic? How much of a threat is the trade tensions we're seeing between the U.S. and China, and how is that sort of part of your thinking when it comes to the market?
So there's several things I think over the next couple months that are a risk to the market. As I mentioned already, from a technical perspective, it's signaling the market's a bit complacent and overbought at these times. You mentioned the U.S.-China trade tensions. That's always a concern. That's been a concern for quite some time now, even before the pandemic. Yeah, there's also seasonality that comes into play. So these are risks that we think could go into the summer months. And the other thing is sometimes
what's up, everybody?
It's just
Market's
a valuation
looking
correction. You
real
can't foresee
good
that.
today.
You just have to be careful that you're not going
I'm not
into
complaining
that
about
valuation
nothing.
correction, buying the most expensive stocks.
Usually I
So
trade
we're
off support and
we're
resistance,
sitting
but
back
this
right
time I
now,
kind of trade
patiently waiting
news,
for a
and it
better
just worked
entry
in my
point,
favor.
and we think you could see that in
So I'm
the
going to
coming
wait
months.
patiently. If
Market,
tomorrow
Megan,
it closes in
10
the green
seconds
like
here.
this,
Jobs report comes in better than expected.
I can
What's your
almost
first
bet
instinct? Buy or
that
sell?
Monday when the market
I
opens
would
back up,
stay where you are. I wouldn't buy though because the valuations are too high at this time. I
we're
would
going
wait
to
to
be
see
in
if
good
there's a
shape.
bit more of a pullback in the market.
All right, let's leave it there. Megan Horniman, Director of Portfolio Strategy at Verdance Capital Advisors. Always good to see you. We'll talk to you soon. All right, do stick around. Much more ahead on the first trade. Las Vegas is back open in business, sort of, kind of. Stay tuned.
Mm.
All right, welcome back to the first trade. It's a big day in Sin City. This morning, many of the big casinos along the Las Vegas Strip are reopening for the first time in months after getting the all clear from the governor and local officials, and it couldn't come too soon. Las Vegas has a whopping 33.5% unemployment rate because so much of its economy is in fact tied to tourism. Let's talk about it and the reopening with Steve Hill. He's the CEO of the Las Vegas Convention and Visitors Bureau. Steve, good to see you. What does this reopening of Vegas mean to your business, but to the city more broadly?
Morning, Brian. It's a great day here. We are excited to welcome our visitors back, welcome people back to their jobs, which is a critically important part of this as well. And it is a great first step. In fact, it's a bigger first step than we thought we were going to be able to take. There's been a lot of demand to come back to Las Vegas. We've missed our visitors. They've missed us, and it shows.
What are you hearing in terms of tourist interest? Are people planning trips there? Are they approaching those trips differently? What's your feeling about, how folks are going to feel about walking back into a casino and then staying in those hotels?
Yeah, I don't think it's unexpected that we're basically seeing our visitors in three groups. There's a group who are coming back today, who can't wait to get back and are excited to do it and are willing to do it in the face of the economic crisis, the health concerns. They trust us. They have peace of mind that Vegas is a safe place to be. The next group is ready to come back, but a little bit more in a wait and see mode. And we need to do this right over the next month, 6 weeks, to show that group that it is both safe and a great time to come back to Las Vegas. And then we have others who are just really not considering returning for 3 to 6 months, somewhere in that range. So we know that it's going to be a ramp from where we are through the rest of this year and into the early part of 2021. But the opening has been really larger, had more demand than we would have originally thought.
Steve, what does demand look like for bookings in the convention center? I know you have CES coming back in the mix here, but do you see businesses renting space out? Is that starting to come back?
Well, it actually, at some level, has just been put on hold. Interestingly, we are going into the next 12 months with the largest schedule that we have ever had. Now, that will look different. It will, it's somewhat questionable as we enter into August and early September, whether some of these shows can actually happen. But our customers also want to come back here at the convention center. They'll just have to come back in a somewhat different way, maybe bigger spacing between displays, larger aisle sizes. The social distancing will have to be a part of large meetings, and we'll evolve through that over the next several months.
Steve, we see the civil unrest in our country right now. Are you over the killing of George Floyd? Are you concerned that might impact demand from tourists on top of the pandemic? Are you hearing that they don't want to travel right now or be in places like Vegas where many people can come together at once because of those protests?
Well, it was a concern. And what we've seen from a booking pattern and a cancellation pattern, that really has not manifested itself. The city, the industry, not only respects the right of the protesters to protest peacefully, we support that. And our police department here has worked with the protesters to make sure that we offer them that opportunity to do so and do it in a way that allows us to bring our guests back to Las Vegas as well.
Steve, speaking of the police, what does that police presence, what will that look like when people start coming back?
Well, they're certainly visible around the protest areas, and they'll be visible anyway. But it will be in response to what's happening on the ground. We have a lot of experience with really large 300,000 people on the Strip and for New Year's Eve, for an example. And there's a very visible police presence there, but there's also a sense of customer service around that. So while that presence is there, they understand how the correct way to deal with our guests, to deal with whatever is going on the Strip.
Steve, how different will the gambling experience look like? I've seen images online, table games spaced further apart. What do the restaurants look like? What are you seeing and hearing?
Well, for the most part, the social distancing dictates what the casino floor, what a restaurant will look like. So that is either, for example, with slot machines, every other slot machine being turned off or potentially removed from the floor, spacing between table games, both in terms of the tables themselves, as well as limiting the number of players at each of those games. So, capacity between 25 and 50% of what it normally is will be kind of the standard for a while.
All right, we'll leave it there. Steve Hill, CEO of the Las Vegas Convention and Visitors Bureau. Good to see you. Good luck. I know it's a big day for you out there.
We appreciate it. Thanks for having me.
All right, and do stick around. Much more ahead on the first trade. Big day for electric automaker Nikola. It will debut on the NASDAQ, and we have the founder, Trevor Milton, coming up next. Welcome back to the first trade. Let's take a look at one of the companies we're watching on yahoofinance.com and on our trusty app. Chinese electric car maker NIO is on the rise after it revealed it had record deliveries for the month of May, and the company received an upgrade from Goldman Sachs. Nes Ferre is back with the details. And Nes, this company's still not making any money, but at this point for them, any news looks like good news.
That's right, Brian. And at the end of April, they secured $1 billion from Chinese entities. So certainly the stock has been rallying over the last couple of months, but you can take a look at the numbers for yourself and you can take a look at the stock, what's happening today. It's up more than 4%. And this NIO announcing that it delivered 3,436 vehicles in May. That represents a 215.5% growth year over year. Now, the bulk of those deliveries were their ES successes that That's the company's 5-seater electric vehicle. The ES8 is relatively new. That's a 7-seater SUV, and those were 751 vehicles delivered. But as I mentioned, the company secured at the end of April $1 billion from state-owned entities, and it's showing also that the electric vehicle market in China is rebounding. It received some recent upgrades, including Goldman Sachs, JP Morgan, Merrill Lynch, who all upgraded the stock. Goldman Sachs increasing its price target on NIO to 640, and also saying it's the first time a domestic premium auto brand has had a waiting list. So you can look at what the stock has done year to date. It's up 46%. You can see right here around the heart of the pandemic, around end of March and April. That's when you saw the stock go below $3 a share. But right now it's rallying today on these latest delivery numbers, Brian.
All right. Thanks so much, Niz. Staying on the car beat, electric and hydrogen-powered automaker Nikola has officially combined with Vecto IQ Acquisition Corporation. The combined company shares will trade on the NASDAQ under the new ticker symbol NKLA. Here with us now is Nikola founder Trevor Milton. Trevor, big day for you today. One of your early investors at ValueAct, Jeff Ubben, has called you a potential $100 billion valuation company. How do you get there, and why does that sound? How can you achieve that?
Yeah, it's a big day today. Obviously, we're traded on the NASDAQ finally. So today is our first day on the NASDAQ in KLA. And to answer your question, how you get there is because we vertically integrated the entire supply chain. It's very similar to Amazon. You know, in Amazon, when you buy something, they handle everything from the warehousing of it to the packaging of it to the shipping of it to the delivery of it, the whole thing. And that's what sets Amazon apart from everyone. Nikola is very similar. In the trucking world, everything's split up. And so when you buy our truck, you get the truck, you get all the fuel with it. It's all zero emission. And then you end up getting all the service, warranty, and maintenance also. So by vertically integrating that whole supply chain, we make 5 times more revenue than our competitors per truck sold.
Trevor, I know a number of companies are trying to come out with these all electric trucks. You got Tesla, Daimler, Freightliner. Yours, though, is the only one that's hydrogen powered. It's a hydrogen powered big rig. I know you had some big name clients lined up pre-ordering some of these, including Anheuser-Busch. Given the pandemic, though, have those orders changed? Are people pulling out of those orders, or are they saying we need a little more time before you actually deliver the truck? What does demand look like right now?
No, I'd say it's probably gone up. The reason that we've seen so far is that people have kind of correlated the sicknesses around the world with a lot of emissions. And you've seen all the countries actually double down on their emission requirements and say, this is a huge part of the problem, so we need to fix it. So Nikola offers both actually hydrogen trucks and also battery electric trucks. So we compete with Tesla and Daimler, obviously. Not just compete, I would say that we are the very first OEM in the world with a full production Class 8 zero emission semi truck coming to market. So next year, our trucks come off the assembly line, and we're the first company in the world with a full production line on our semi truck. So we beat everyone to it. And then we have our hydrogen truck coming the year after. So I think that's why there's been so much excitement about Nikola is we don't just cover one part of the market. We essentially allow people to have either option, both battery electric for up to 300 miles and then hydrogen for over 300 miles of range.
Trevor, the last number I saw on Nikola, you had 14,000 pre-orders representing close to $10 billion in revenue. What's the latest number?
That was actually quite a while ago. We stopped taking orders for a period of time. It was ultimately what happened was fleets were being told they were going to be 5 years out, and that's just too far to plan. So once we hit about $10 billion in orders, we were just making people mad. So what we did is we just kind of put a stop to counting the numbers. If we were to open all those order books up right now with all the people that have said, hey, we want these trucks, you would see a much, much, much higher number than that. But it just ultimately just made people mad waiting that long.
You know, Trevor, hydrogen-powered vehicles have never really caught on in the passenger car space. Do you think, why is that first off? And do you think that might change over the next decade or so?
Yeah, so in the passenger car, it's a little more difficult because the cost of a fuel cell is pretty expensive. And so you don't have like an economic return on that. And so it becomes more of a philosophy or a belief to own a hydrogen vehicle on a passenger car level. They are awesome. I think the cost will come down eventually. But what Nikola solved was the economics on the trucking. When we first started, hydrogen was $16 a kilogram. We can now produce it for well under $4 a kilogram. So we've cut, it's 1/4 of the cost now than it was just a few years ago. And we're now cheaper to operate per mile than diesel. And I think that's the key why. And with a semi truck, you're making that money back on a daily basis. So people, if there's a, X amount of premium on the truck over a period of a few months or a year or whatever it may be, they can have all their money back already. It's a return on their investment. And it's because that vehicle makes them money. That's why it's been so successful finally.
Trevor, people close to you know you as a person of great faith. What if you told your 350 employees about the unrest, the social unrest sweeping the country? But importantly, what are you building in terms of diversity as you scale this company up? You're in a very unique position, a lot of orders, really key business. But how are you building that into the DNA of the company?
Yeah, from day one, you'll see that. Nikola was founded that way from day one. Around the employees are family, and when you have family, you don't look at them any different than my family's my family, regardless of who they are, right? And I think that's what's amazing is that there is no difference between anyone inside of Nikola. We have an enormous amount of diversity here, probably one of the highest women to men ratios in the entire automotive industry, which I'm really proud of. Hard part is you can't, there's so many people out there looking for great diversity inside a culture. It becomes harder and harder to maintain that culture. And I think that's what's cool about Nikola is from day one, we've just been a mix of everything around the world. And we just treat everyone like family. I mean, here at Nikola, there's nothing's tolerated ever. Someone's ass would be out the door so fast if they ever discriminated or harassed someone. It wouldn't even take 2 seconds. I don't care who they are, how long they've been here, they'd be gone. And for me, that's one of the things that I think people here at Nikola know is I mean, when we have company barbecues, I'm the one flipping the burgers for everybody. You got to serve your people. If you don't serve them, you can't love them. And I think that's a big thing. I mean, I'm a big believer. I mean, faith is a huge part of my life. And you truly can't love people unless you serve them. And so I serve my employees every day. And they know that. And that's one of the reasons why you see such good morale here at Nikola.
That's certainly good to hear.
Today is a wild day in the markets once again. I'm up 20% in a stock that I bought at post-market yesterday.
On the NASDAQ in KLA. So wonderful. Thanks so much. Bye, guys.
All right, do stick around. Much more ahead on the first trade. We'll look at some potential changes in voting come November. Stay tuned.
Check this out.
All right, welcome back to the first trade. To start today, the market was in the red pre-market, but now it's in the green. Let's check in with Inez for a close look at these rallying markets. Inez?
And Brian, take a look at the airlines up double digits this morning. Look at American Airlines up more than 26%. You've got United that's up more than 8%. Delta up more than 11%. China says that foreign airlines blocked from operations in the country due to COVID-19 will now be allowed to resume operations. Part of the reason why you're seeing this rally with the airlines. Also looking at Royal Caribbean, that stock is relatively flat right now. Royal Caribbean said it's offering senior notes and convertible bonds that mature in 2023. The proceeds of the offerings will go towards general corporate purposes, which may include repaying debt. Year to date, the cruise liners are really suffering. They're down more than 56% for Royal Caribbean. And then just taking a look at Twitter, that stock slowly under pressure. Twitter CEO Jack Dorsey says that he is going to give $3 million to Colin Kaepernick's organization, Your Rights Camp, to advance the liberation and well-being of Black and Brown communities in the U.S. And you'll recall that Jack Dorsey not too long ago said that he would be donating $1 billion towards different causes. This is one of those causes, and he's been very transparent about it, putting all those charities that he's donating to in a Google document on Twitter for everybody to see.
All right. Thanks, Inez.
Thanks. All right. Well, we know that state primaries are continuing, but they're looking a little bit different this year. Due to COVID-19, more and more voters are opting to mail in their ballots. And of course, the big question now is, what does this mean for the November 3rd presidential election? Here to talk about it with us is Bradley Tusk of Tusk Ventures. Bradley, good to see you again. So what do you think this means? Will mail-in ballots mean that more people will be voting come this presidential election?
I hope so. I mean, interestingly, the election that has the least problems with turnout is the presidential election. Where we really run into problems is local elections, state elections, where all of a sudden, like for example, you remember last year when Amazon tried to put 25,000 new jobs in Queens and they were chased out of town, the city councilman who led the fight against them had 12,000 votes total cast in his primary. So, you know, what tends to happen is people really at the extremes on the left or the right end up controlling the process because they show up to vote. Presidentials tend to have the best turnout, but yeah, I think with mail-in, you know, if you look at the states that have done it successfully, like Colorado and Washington and Oregon, they've seen increased turnout.
We know that President Trump has come out pretty vocally against mail-in ballots, saying that fraud is rampant there. We're leaving the door open for a lot of fraud. Some people say that's not true. What do you think about that? Where do you stand?
I think every form of voting is flawed, to be honest. You know, I'm a big proponent of mobile voting and have spent a lot of time and money trying to move that forward. And yet we're still in the infancy of it. And while I think, you know, we can do small groups of people in certain states, that's what we can handle right now. A lot of the experts love paper ballots, but for those of us who remember 2000 and Bush v. Gore, you know, paper ballots ended up changing the entire presidential election in the wrong direction. And voting machines have problems all the time, especially any of us who vote in New York City know that, because you just end up waiting in line forever to use them because they're always broken. So every form has problems. I do think the president is exaggerating it, but he is generally prone to exaggeration.
Bradley, we haven't spoken to you since the protests begun. Curious on, in your political circles, what are people saying about Joe Biden's response over the past week?
Yeah, I think it's been fine, pretty well. I mean, I think what we're all realizing is if Biden went on vacation today and came back the day after Election Day, I'm not sure the results would be any different whatsoever. Re-elections for president are always a referendum on the incumbent. And in this case, because the incumbent is such an outsized personality for better and for worse, and because we're in the middle now of a recession, a global pandemic, and massive civil unrest, I'm not really sure people that are voting for Trump or against Trump. I don't think that much Biden does either way is going to make a difference.
I'd love to get your take on President Trump and what he's been saying lately about social media platforms, in particular Twitter. They sort of have this tug of war going on, very public tug of war going on right now. What do you make of that? And might that hurt Trump come time for voters to vote?
Yeah, I don't know if it'll have a big impact on the election because it's a pretty obscure topic. But as a venture capitalist, I actually would like to see Section 230 repealed. Section 230 is the federal law that gives platforms like Twitter and Facebook immunity so that if you or I posted something really crazy, they're not liable for anything that we say. If that protection were removed, and what's interesting is both Trump and Biden support removing that protection, I think in a way it would really allow new social networking startups to come about, to innovate. Right now, it's just impossible to compete with the monopolies like Facebook. But if they have to do more than just give you a quick dopamine hit, provide a better value proposition to the customers, I think there's room for a lot more innovation in the space. So I would love to see Section 230 repealed.
Bradley, how impactful is it to President Trump's re-election chances that now we're seeing retired military folks like General Mattis speak out against him?
Yeah, I mean, I think it's two things. One is there are a lot of people who, for example, in 2016, either voted for Trump because they just didn't like Hillary or they stayed home. And I think that uncertainty is going away more and more. But what was even more 10-year-old asked me, well, if Trump loses, will he leave office? And I was thinking about it. And when you think about where coups succeed around the world, it's because you have the military. And if Mattis in some ways is reflective of how military leadership, even though he's ex-leadership now, thinks about things, in some ways it's even less about how that might affect the election in November and more around Trump not trying to contest the outcome of it.
You know, Bradley, how important is the black vote in this particular presidential election now with all of the civil unrest happening just months before we're going to be going to the polls? Trump is not hugely popular with black voters, although he did get a slice of that pie in 2016. So how important are they this time around?
I mean, very important. That's why Joe Biden is the nominee. And if you look at the handful of states that are swing states, there are really big African-American populations in Ohio and Pennsylvania and Florida and Michigan and Wisconsin. And so turnout's going to make a really big difference. Some people would argue that the lack of black turnout in 2016 is why Hillary lost all of those states kind of in the upper Midwest by pretty small margins. And had she focused more on turning out black voters, she would have won.
All right, let's leave it there. Bradley Tusk of Tusk Ventures. Always good to speak with you.
Yeah, thank you, guys.
Talk to you soon.
Bye.
All right, do stick around. Much more ahead on the first trade. We'll dive into the current state of the U.S. housing market.